Thank you very much for joining TechUK's series of interviews on operational resilience. My name is Hugo, so I lead TechUK's financial services program. And today I'm delighted to be joined by Wayne Scott from NCC Group, who's an expert around operational resilience. And TechUK has been working on operational resilience for more than a year, particularly working with the PRA on stakeholders on the new packages that was published by regulators in the UK with new requirements around outsourcing, around resilience. And now we've got a bill around the critical third-party providers and a discussion paper from Bank of England. So it's really a key timing for us at TechUK to come together and assess what do we think the best position for the UK to take around operational resilience, and especially assess the regulations that are being developed across the globe. And of course, the EU has been developing its own regime with DORA, and now the UK is developing its own regime. So it's really good timing for us to have this discussion today with Wayne Scott. But without any further ado, I just want to give Wayne the opportunity to introduce himself. I mean, Wayne, it's great to have you today, and I said it's key timing for us to have a chat with you. It'd be great to sort of know a bit better about your role and your organization's role when it comes to operational resilience in financial services and in the UK, and also know a bit more about what do you think is exciting about operational resilience and why it matters and why you think it's relevant and why you're spending so many hours working on this. So it'd be great to get a bit of information on this, and I'll move on to the landscape and the regulatory framework.
Hi, Hugo. Yeah. Thanks for having me. Appreciate it. Long time listener, first time caller. My name's Wayne Scott. I'm regulatory compliance solutions lead here within NCC's software resilience division, and NCC's split into two divisions. On the other side of the fence, if you like, we have our cybersecurity business that do cybersecurity assessments, advisory, detection, response, compliance, remediation, all of that kind of stuff, from cyber essentials to full spectrum attacks. And in the resilience division, we focus specifically on the implementation and delivery of technology escrow agreements for source code and cloud services. So my personal role revolves around identifying and acting upon and influencing regulatory change. And part of my role is doing things like this, talking to people and training people. I try and make sure our products meet the regulatory requirements. And I also help to build the consultation paper responses issued by financial services regulators globally that relate to third-party risk management, supply failure, outsourcing.
And here you mentioned around training, and we'll come into that later on, some of the new regulations. I mean, there's been a lot happening in the industry in the last couple of years on industry. Bank of England talking to industry about outsourcing and resilience, and now we have a discussion paper around critical third-party providers and resilience. I mean, how aware are the people you train about the new requirements, what's happened in the last few years, and where we at now with this new discussion paper? How aware do you think people are and receptive about your messages?
I mean, the people that I train here, Hugo, are our internal colleagues, basically, and people on the other side of our business. I help them to understand the sort of the interconnected versions, nature of what we do, and how technology escrow touches across a number of different subjects, from legal, procurement, IT, risk, resilience, disaster recovery, business continuity. It's a very wide-ranging product. I wouldn't train anybody externally on it at the moment. Where the market's at on it is an interesting question, but I'll come on to that a little bit later, if that's okay.
Yeah, absolutely. And talking about where the market is, I mean, of course, the discussion we're having around operational resilience is partly driven by the change we've seen in the last decade. I mean, there've been a huge amount of digital transformation, new tech, innovation, that has really changed the landscape. We also have consumers' habit changing, different trends of the consumers spending, using financial services, as well as the workforce being digital, working remotely, working in the office. There's been a lot of different trends on shifting the market, and of course the pandemic has been a big push and that changed the landscape quite a fair bit. What have been your key takeaways from both the last decades of digital transformation on the impact on resilience, and as well as the last couple of years and what the pandemic has been shifting in terms of the approach from industry, as well as the workforce and consumers, how everything combining all together? What have been, you think, the key takeaways from you, and how much that's changed the conversation around operational resilience?
I'd say there's a couple of different questions there, but yeah, I'd say resilience has always been critical within financial services, but recent events like Brexit, the pandemic, the terrible war in Ukraine, combined with some long-awaited regulatory changes around operational resilience, have compounded the criticality for this situation and sort of elevated the discussion. NCC service, we've been providing this to global financial services industry since about 1984 or so. So we can list the majority of systemic banks, insurance companies, investment management companies, stock exchanges, regulators as customers. But because of the nature of an escrow agreement, we also have extensive relationships with the outsourcers, the ISVs, the providers to those companies. So a traditional technology escrow agreement, a source code escrow agreement, it revolves around the continuity of service for on-premise deployments of software. Now, historically, from a regulatory point of view, financial institutions only really needed to have a comprehensive business continuity plan, and we'd argue that, how can it be comprehensive if you don't assess for supplier failure? So, with a source code agreement, what we would do here is we would document the build process. We document all the hardware, tools, and software involved in building that process. Build a document, put it underneath an escrow agreement, and then we'd store that along with all the a frequently updated version of the source code. So, if the event a supplier fails, or they can no longer maintain the software, or they sell the company or sell the software to another company, what we'd do is we'd release everything to them that's required to maintain and continue to use that service. It buys them time, if you like, to source another supplier. But what's changing is as an agreement, an escrow agreement will always mirror the license agreement and also mirror the deployment method. So with the introduction of cloud, we've had to significantly change the way we deal with escrow. With software as a service, a build manual, the source code, alone, it's not going to be too much use to the end users because they don't have a copy of the service. So what we've done is we've come up with two different versions of EAS, escrow as a service, that as we call it, one for single tenanted services and one for multi-tenanted services. So we still document the build process. We take the copies of the source code, keep that frequently updated. But for a single tenanted service, we'll take the access credentials, the mechanism to enter the environment, store that underneath the escrow agreement. Or if it's a multi-tenanted services, we couldn't store those access credentials because of GDPR gave everybody access to all the other people's data. So what we do is we ask the service provider to build a fresh instance of the service, spin it down, store it underneath an escrow agreement, store all the relevant party data in there as well. So, if a supplier fails, you can either spin up the replicated instance or access the environment directly, keep the service running, keep the lights on in, and they'll still have all the source code, the manual and stuff to be able to deploy, and administer administration of the service. What we saw through the pandemic then is SS121 and SS221 coming in the UK, and that mandates the mapping of all the interconnected nature of the outsourced services, the definition of material and non-material services, and SS221 dictates that anything material should have a stressed exit plan. And that plan should mitigate supplier failure, service deterioration, and concentration risk. And the plan must enable the financial institutions to either bring the service in-house or pass the management of the service to another supplier. And you've got to test that plan and prove that the plan works. And so, this is sort of right at the start of the pandemic when this comes in. This is when SS221 comes in. And within that regulation, one of the first regulators to name escrow as a viable solution for active consideration as mitigating these risks. Escrow ticks all the boxes on when it comes to proportionality, and those risks of supply failure, service deterioration, concentration risk. Well, they're the release events under escrow, and have been, for 30 odd years. And documenting the bill process, well, that's just a way of proving that your plan works, if you know what I mean. But yeah, if you're looking for, we're in a unique position. I can rant, can't I, Hugo? I apologize. We're in a unique position here at NCC Group because, we deal with the owners, as I mentioned, and the licensees. We deal with all the users of it. So we can give you what we saw happen as well at the start of the pandemic. We saw, everybody saw an unprecedented shift to home working, didn't they? I'm sure a lot of sales managers loved that. But and our cybersecurity side of stuff, guys, that they noticed a huge spike in malware attacks and phishing attacks, and it's pretty documented globally. We saw different set of risks, ones that you most probably wouldn't see outside of technology escrow, from a fintech side or something. We saw the software sales cycle and procurement cycle stall. It didn't die. It just slowed right down. Implementation, new projects, go lives were all held up. And if you're a fintech, and the majority of fintech's business models are based upon demonstrating growth, aren't they, to attract investment? Any delay, any stall, any pause isn't good. And if you're a financial institution, well, these guys don't go off and implement and buy new services at the drop of the hat. There's normally a cost saving or a feature benefit to that change, and ramifications of not being able to implement that are pretty big, really. I don't know how you'd work it out, but the overall cost of it, that'd be interesting. But what we also saw then is existing in situ services. The criticality of those services were compounded, because they couldn't move, they couldn't change. It was maybe risky to deploy patches, bug fixes, those kind of things. So, what we saw is an increase in new escrow agreements and new verifications. We saw cloud agreements being set up, additional versions being deposited underneath the agreements, and we had to. Well, we had to shift to remote verifications. It's the first time we'd ever done that. 100% of our verifications. We used to do them all on site, but now we had to move to that. But if a resilience company can't cope with a global pandemic, we wouldn't be very, very good.
Do you mind if I interject here on
of course.
On the remote online verification? How has it been adapting to that from your perspective?
It's something we kind of introduced maybe about 10 years ago, and started to try and do it. There's a couple of, we had a smaller team of verification consultants back then, and there's a couple of countries that, you can go to that country, but that means you can never go to that country ever again. A political prevention from doing it, but there's also some pretty substantial fintechs based in those particular regions and areas and stuff like that too. So we started doing these verifications online a while back. And I suppose in some ways we were a little reluctant to move to it. We like to kind of sit there and see the things be built. There was a bit of maybe a preconception internally that should something hits a snag or start to fail on a site, our verification consultants, being pretty well trained, indeed, might be able to help the process go along. So what we saw is we were a little bit a step further back from it. We were so we had to take time a little bit more to make sure the process was documented, and overall what it really did was it just improved the end result. We had to become more hands off and the service providers, the verifications, the people who were building the programs, had to be more successful in delivering what they were being paid to do.
Yeah. If you don't mind me going back to some of the bits you covered, you mentioned the supervisory statements from bank, I think from the PRA was published 2 years and a bit on Mona already, and that sort of came almost like considered with COVID and the impact of COVID. From your perspective, dealing with your customers and clients, how's it been? Have your customers and clients changed in the way they've dealt with resilience when both COVID and a new set of requirements on new package was published by the PRA? As these two together completely change how people talk about resilience now? Has it changed everything much?
It's interesting. It's not changed as much as it should have. Okay, and it is getting there. It was in the SS221 requirements. It's kind of the requirements of it are kind of stuff that's supposed to be happening anyway. It wasn't particularly mandated. It wasn't laid out and said you must do this. So you've got some financial institutions and brilliant, some systemic financial institutions that were already all over it. They were already doing the vast majority of the requirements. They'd kind of acknowledged that escrow meets the majority of them, and it meant very little to no changes for them. Then you had some financial institutions out there that acknowledged that they didn't have the skill set in house. They went out and hired third-party risk management experts, and went off to build these stressed exit plans. But what seemed to have happened is in a lot of financial institutions, a lot of them assumed that IT didn't already have a solution for mitigating supply chain failure, and they went off and did a load of investigation at great cost to come back and put 2 and 2 together and suddenly realize that the solution's there and it's been around for 30 odd years, and it's cost effective too. So now what we're seeing is because of COVID, because of the pandemic, because of Brexit, because of horrible stuff going on in Ukraine, the entities are starting to understand the non-technical risks associated in the use of technology. No amount of cyber security could have protected those financial institutions from the risks that those events posed.
You mentioning this, and I want to have a quick chat about the bill, the policy statement from Treasury, because there is operational resilience from the company's point of view is them making sure their resilience, them making sure they've tested their processes or softwares or hardwares, and then having an exit strategy, etc. But then there's also a bit where that they don't control because financial service providers will be using third parties, and there's only so much they can actually know about what's happening with the third party ecosystem. And we had a webinar, I think, last year, and there was a joke about in terms of auditing, trying to go to a big cloud computing providers with a USB stick and going there, and how do you audit this sort of setup and infrastructure, because they have to be very secure. So there is two elements here: is making sure a bank or a fintech or FS providers is resilient, and they have to make sure they do their due diligence, and they've done the testing, and they got their contingency plans. But there's only so much they can actually know and do, and it may be why now regulators, and we've got this discussion paper now from Bank of England, maybe we can touch on that, and also in the EU we've got DORA, so a directive kind of looking at what the UK has been doing on resilience, but also looking at ensuring the third-party ecosystem is resilient and ensuring there's no systemic risk. If, for example, say there's a concentration of IT providers in one area. So it'd be great to have your thoughts on these two elements where regulators initially have the requirements on supervising what each companies were doing in the industry, and now trying to have a look at actually how big the third-party ecosystem is, and how do you assess and ensure financial stability and ensure fewer disruption as possible and avoid systemic risk in the third-party ecosystem. So it'd be great to hear some of your thoughts on that, on the discussion paper, and where you came to that.
Yeah, obviously I'm biased, but I love this discussion paper. I really do, and I've been talking about this for quite some time myself. I think it's paramount. I think it's necessary. It's the final piece of the puzzle, really. What we we've certainly seen over the last sort of 2 years is that a number of financial institutions want to have a demonstrate to be successful stressed exit plan, but they had no mechanism other than at the point of contractual renewal to make their suppliers do it. There was no way to enforce it. I think this CTP stuff, the critical third party stuff, it's kind of preceding but mirroring DORA simultaneously. Longer term, I think what we'll see is this type of regulation spread out across other UK industries by their regulators, and then in turn around the world. The bank is leading the way on this discussion. And if you look at it over the last decade or so, we've got 2 or 3 really big user cases of supply chain failure within UK financial services that we're all really familiar with. But I think to the critical suppliers, it might all look a little bit scary, but all it really does do, and this is how I expect it to kind of pan out, is mirror SS221. Certainly the financial markets infrastructure stuff that's just the consultation just closed. Sorry, the consultation just closed recently. I think that'll be announced at the start of the year, and that's applying to the your payment services and stuff like that. That mirrored SS221. It wouldn't make sense for the third and final piece to be different from the others, and if it is different from the others, then it wouldn't fall in line with DORA. What they've got to kind of do is apologies, I'm trying to what they've got to do then is they've got to sort of identify and map their services. They've got to test, they've got to look at the communication methods and learn and evolve from any mistakes. But it's all stuff that's expected of the CTP's customers anyway. They might even be able to help them. Really, it should already be happening now in a number of outsourcers. It already does. The bank's just sort of mandating it and ensuring they've got a right to double check it's happening, and if it's not happening, then enforce it to do so. That seems fair to me. With a number of critical suppliers, it'll just be business as usual. They do all this already. It may be a matter of just proving a couple of their stressed exit plans work. For other critical suppliers, this will be the first time they've looked at financial stability of the supply chain, and first time they've thought about the effects of service deterioration, or even looked at the stability of their own supply chain, or maybe even the concentration risk that they present or it could present. Cloud providers, there's actually less work for them to do, really, because of the shared responsibility model. They're on top of the cybersecurity. You can't question the cybersecurity of the majority of cloud. And the chances of a cloud provider going bust, are very, very slim. So mitigating those risks with any kind of stressed exit plan most probably wouldn't be proportional. But it's what's within the cloud that's the risk. I think there's a really good opportunity for the cloud providers here. I'd be considering some kind of operational resilience baseline that has to be adhered to. Any ISV that comes into their cloud has to meet these criteria before doing so, particularly anything that's in the marketplace, because these stressed exit plans need to be in place and be demonstrably workable at the point of purchase. The point of signature, and that point of signature is a click in the marketplace. I suppose I'm kind of saying they've got a chance here to operate as a resilience gatekeeper, if you know what I mean.
Yeah, and do you think for some of the smaller players that do provide that are part of the supply chain on third-party ecosystem and provide direct services to to financial services providers that won't necessarily be in the scope of the new measures. But is there like a potentially for them a concern that they would fall into the scope at some point, or they suddenly become being seen as a CTP later on because they, even if it's not a critical service, they're in almost like a monopoly or a small pool of providers providing that service, and therefore they're being brought into the scope of this?
Do you know that danger? That danger's not the right word. I apologize, but you know that scenario is a there's always potential for it to happen, isn't there? But it's for smaller companies, for fintechs that start or anything like that. It's really easy to accommodate these regulations from the outset, as long as you start from that baseline. I've been talking about something for quite some time. I've been talking about a concept I mustered together called resilience by design. I've been talking about for about 2 years or so. And if you adopt the principle that, you know, you kind of assume your own failure by default, does that make sense? If you you know you've got faith in your product, it's going to be a good product, it's going to provide a service, but as long as you think that, oh, something bad could happen to us somewhere along the way, and have those backup plans available and ready for your customers, and you start from that building block going forward, building that resilient design, yeah, it'll open up opportunities. It'll open up new markets for it. You know, if you look at some of these core banking providers that are out there, I don't know, treasury, reconciliations, a number of them have been struggling to move to the cloud. You know, never mind building something that could be stood up by an independent third party. So within that regulatory change, you know, there is always opportunity. Yeah.
And a follow-up question on this, on the new framework, because I think you mentioned that potentially and hopefully for most companies that fall into the regime, the requirements on what they will have to do wouldn't be a huge change to what they're already doing or should be doing. But having said that, I know some larger firms have been taken by surprise by the policy statement and the bill. So do you reckon then, therefore, still that the new regime won't necessarily change much for most providers?
It doesn't have to. Okay, it doesn't have to. It doesn't have to. It's acknowledging and understanding, you know, kind of what we do, and there are other providers of the services out there that do what we do, and understanding that, you know, that these requirements can be met quite easily. For big suppliers, you know, it's kind of thinking small. You know, it's like, if we were a smaller company, what would our customers demand? You know, you know, nobody ever got sacked for buying IBM thing. Yeah, you know, you got to treat yourself as small, and what would our small competitors look to offer there for it? Yeah, I mean, it's interesting. What I think will happen from there as well is we'll see that the critical third parties will start to look at their own supply chain and look at the weak points. Look at building out stressed exit plans for those other parties that's there.
Do you reckon? I'm sorry. Do you reckon that the regulators have that in mind? Is actually by by having this CTP regime, they're hoping that will also push down some more scrutiny and ensuring with the best practices across the whole third-party ecosystem, not just the larger players.
Definitely so. I think it'll become sort of regulation by proxy. You know, it will make, you know, if you can't get into the cloud without having a resilience offering, if you can't, you know, provide your open banking APIs to a core banking provider without being resilient, you know, if the regulation sandboxes details resilience within there, if universities are talking about resilience, you know, it just becomes that little step that you just automatically conform to. Nobody bats an eyelid now at cybersecurity or code checks or firewalls, but it's just that little bit there. It's have you mitigated financial stability, service deterioration, concentration risk that you should is your processes, are they documented? Can somebody else stand that up? When it comes to cloud services, from within the regulations, there is a bit of a sticking point there that there's need looking at, because one of the definitions and the criteria for if you're going to be defined as a critical service is what do you call it? I think it's interoperability. I think it is, or substitutability. And that's not something that's easy to do right now. It's not easy to go, all right, I want it in Amazon. Oh, change my mind, I want it in Azure. There's a process to it. There's an element to it there. But for your smaller companies, starting off with a cloud agnostic stance, that's extraordinarily resilient.
Perfect. I've got one final question for you, Wayne, because we mentioned DORA, we mentioned the EU, and we mentioned cyber, for example. And I know when it comes to cyber, the UK, the EU, the US, and Japan are doing their own requirements. And I know some companies aren't necessarily happy with the friction it creates when you've got a global business and you got to operate in different jurisdictions. In terms of operational resilience, and I know some of the requirements are more potentially principle-based or outcome-based, but do you think there is a case to, especially if you mentioned earlier that we're starting with financial services, but regulators or governments across the globe may look at other industries? Is there a case for call for better cooperation and interoperability between the regulatory framework across the globe when it comes to FS, but also if it goes down to other industries? Is there like a worry or a case to be made?
Definitely. Yeah, there needs to be more chats going on at the moment. But let's be open about it. The UK leads the way on these discussions. They really do. UK, Singapore lead the way on these kind of things. And once a kind of solution is proposed by our bank, other regulators are maybe less prescriptive, maybe less, I don't want to say in specific, but you know what I mean? Not as forthright on it, but the plans that are being laid out, the regulations, legislation that's been laid out globally are all very, very similar. But what they do is allow a freedom to be able to meet those regulatory requirements in your own way. UK regulators and other verticals outside of financial services, they are all over the cross discussions between regulators at the moment, and are looking for. They are looking for financial services to lead the way, to be open. We're ahead of the game on this. The DCMS reviews revolving around NIS. I think the results are due by the end of this year on that particular one. OCC, OSFI, their final stuff will be out towards the end of this year as well. Hopefully FINRA as well, and the Australian Prudential Regulation Authority. But they do chat to each other. The recent Hong Kong reviews on operational resilience quoted that they'd had extensive conversations with the PRA as well, and it becomes then much easier for fintechs or any technology company to be able to meet global regulatory requirements if there's a standard. Why have different operational resilience solutions for region by region if there is a one size fits all that definitely meets all those requirements? It's kind of lucky really with us at the moment and with technology escrow, because we do that. Within the new regulatory announcements, more and more frequently escrow is being either directly or indirectly named.
Thank you very much, Wayne. We'll be engaging with the Bank of England, the PRA, and regulators and government on the bill and the discussion paper, and hopefully we can get some of your thoughts and pick your brain again, Wayne, on this. And I know you're quite optimistic and enthusiastic about the approach on the discussion paper, on the approach from the policy statement. perhaps do you have any sort of further thoughts on something we've missed, or perhaps an advice for if we're talking to a technical member that's been surprised by the bill? What would be, for example, your advice to them in terms of if they would fall into the scope, or even if they don't fall into the scope, they want to be ready if they have to comply with some new principles or outcome-based rules?
I think, you know, the advice would be is just to take a look at, you know, the resilient nature of your own service and your own supply chain. Treat yourself as if you're going through a tender from one of your customers. Would you meet the regulatory requirements imposed on a financial institution that you're selling to if you were that, you know, that you were that entity, if you were that particular company? That's the way that I do it. I know the Bank of England is saying they're going to do the best to keep this list of CTPs to a small number. When you look at the nature of the software market, and you look at the different services that are under different consideration, I'd be very surprised if this CTP list is under 100 companies.
You're going to worry some members here.
Well, it's not intended that. It's not intended to do so. But you know, when you look at, say, a particular service provider that only maybe provides to building societies, it's a small market, but there's a lot of value in there, isn't there? There's a lot of assets invested in. Or then if you maybe look at when we look at concentration risk, maybe from an activity risk or systemic risk or an entity level risk there, and then suddenly establish that you can't, you know, there isn't that substitutability of it. To me, it looks like it'll be a wide list. It doesn't need to be painful, though. You know, that it's.
And do you think then, because you said perhaps they intended as a small list, but it's going to be probably a bigger list than initially. So do you think they realized that when they started the regime, that it's probably going to be, they'll have to have a big list, relatively speaking? Do you think they realized that? Because sometimes we've had new regulation, new requirements, and suddenly the regulators can't cope with how much reports they've asked companies to give them. Do you think they realize the task from the government treasury or of the regulators?
I'm not sure if they would have. You know, they've got the information now. Let's be open about it. Through SS 121, they've got a list of everybody's material applications. Yeah, they know that now. Yeah, that information's all collated there. And you know, you might have one core banking supplier that maybe supplies to 2 systemic banks. Are they a material supplier? Well, I don't know. Let's have a look at their other customer base. Oh, well, they've actually got 3 systemic banks in the UK and 2 in Switzerland. And you know, when you map it out, you know, financial services industry is interconnected, and what affects, you know, we saw it with the 2008 crash, didn't we? We saw it with a concentration of risk, debt with a small amount of suppliers, and pretty bad regulation. You know, when arguably some industries are improved by a disaster, but financial services is only damaged by it. And we've got to avoid that kind of thing from happening again, really.
Yeah, absolutely. And thank you very much, Wayne, for your time. It's been a pleasure talking to you today. I'm sure we'll be asking to pick your brain a little bit more on the discussion paper, and it's good to finish off on talking about why we're talking about it. It's because it matters. It's because at the end of the day, financial service providers provide critical services to consumers that need to get money out. They provide critical services to SMEs and companies to move money, to spend money, save, etc. So it's indeed really important. Operational resilience. It's a challenge for everyone, and to nail resilience is important for all consumers and for everyone in daily life. It supports the economy, so it's vital that we get it right. And I think it was good to finish off on that and mentioning why we're doing resilience. And it's for that, because because the industry is really important, and we can't function without it. So let's make sure it fits the framework and the technology and innovation and the regulatory framework is fit for 2022 and future-proof as much as possible. So thank you very much for your time again, Wayne. It's been a pleasure talking to you, and looking forward to chatting to you again on resilience in the coming weeks on that discussion paper. Thank you very much, Wayne.
Thank you, Hugo. I appreciate it. Thank you.